Hey everyone, welcome to The Deep Dive. We're your Talk Tickers team, and we're here to cut through all the noise and get straight to the point on what really matters.
That's right. We dig into the details so you don't have to.
Today, we're zooming in on Evercore, specifically their second quarter 2025 earnings call. That was the one that happened pre-market, July 30th.
Yep.
And our goal here, like always, is pretty simple. Give you the critical info, maybe some surprising bits so you feel genuinely informed, without getting bogged down in endless reports.
And this one had some interesting market action attached to it right away.
It really did. The stock price jumped significantly right after the announcement, but then, well, it faded a bit by the close, settled more modestly. Mm-hmm. And that little that hint of something else going on, that's kind of what we want to unpack today.
Exactly. That initial pop and then the pullback.
Yeah.
It often tells a story, doesn't it?
Mm-hmm.
Maybe expectations weren't quite aligned or there's just more nuance there. We'll get into it.
Okay, let's start with the headline numbers then. Because Evercore, they put up a really strong quarter. They didn't just meet expectations, they significantly beat them. Top line, bottom line, both looked good.
Yeah, it wasn't just a small beat either. It was pretty substantial.
So what does that kind of performance tell you, especially right now? Are they just riding a market wave or are they actually, taking share?
That's the million-dollar question, isn't it? And I think the numbers suggest it's probably a bit of both, but maybe leaning towards them executing really well.
Okay, lay the numbers on us.
All right. So adjusted earnings per share, they came in at $2.42. The consensus was looking for $1.74. So that's a massive beat, like 39%.
Wow. Okay.
And the net revenues hit $833.8 million. Again, consensus was lower, around $704.4 million. So an 18% beat there, and that's up 21% from last year.
Those are definitely strong numbers, record-breaking even.
They are. Record revenues for Q2 and actually record revenues for the first half of 2025 for Evercore. It really paints a picture of pretty solid financial health. So to your point, yeah, the market conditions might be improving a bit, but they seem to be really capitalizing on it. And importantly, converting that into profit, that suggests they are picking up share in key spots.
And you mentioned profit, the adjusted operating margin was 18.7%. That's up, 230 basis points year over year?
Yep. A nice jump in margin.
Yeah.
And their core business advisory fees, that surged to $698 million. That's a 23% increase compared to last year.
So growing the top line and expanding margins, that suggests efficiency, right? They're not just buying revenue.
Exactly. It's efficient growth. It signals real momentum, not just recovery. And you see that effective cost management playing out alongside the strong revenue.
Yeah.
For a boutique firm, that agility is key.
Okay, so speaking of growth and strategy, this is where it gets really interesting, I think. The big news item was the acquisition announcement. Roby Warshaw.
Ah, yes, the Roby Warshaw deal. That's a big one. A leading advisory firm based in the UK.
Definitely a significant move. What's the thinking behind it? Is this about cutting costs, finding synergies, or something else?
It seems like it's definitely more ambitious than just cost cutting. So it's an all-cash deal, roughly $196 million or 146 million pounds sterling.
Okay.
Structured in two parts. First bit is paid in Evercore stock when the deal closes. The second payment happens a year later, and that can be stock or cash. They'll decide together. They expect it to close around the start of Q4 this year.
And Roby Warshaw, they bring quite a client list, don't they?
Absolutely. An extraordinary franchise. They've got relationships with over a quarter of the FTSE 100 companies. And get this, they've advised on 7 of the 10 biggest M&A deals in UK history.
Wow.
So what management really emphasized on the call was that this is about revenue. It's not a cost synergy play primarily.
That can work.
Yeah, the idea is you combine Roby Warshaw's super trusted, deep relationships with Evercore's wider range of products and their deep sector knowledge. The goal is to grab more cross-border deals and just offer more value to those big clients.
So really expanding reach and capability, not just trimming fat. And they expect it to add to earnings right away, adjusted and GAAP EPS in the first full year.
That's what they said. Accretive to both adjusted and, importantly, GAAP earnings per share from basically year one. GAAP, of course, being the standard accounting rules.
How big a deal is that financially? Does it change the risk profile of their M&A strategy?
It's pretty significant. Being accretive on both metrics, especially GAAP, straight away, it really underlines the financial discipline behind the deal. Shows they're confident it'll contribute positively right out of the gate.
Right.
It's not just growth for growth's sake. It's profitable growth. And think about the scale. This adds a huge presence. They'll have over 400 bankers across 9 countries, just in the EMEA region, Europe, Middle East, Africa.
That's a major step up in Europe.
Definitely scales up their European footprint significantly. It really reinforces that global ambition. And because it's focused on revenue expansion with such a high-quality firm, the risk feels maybe lower than some big speculative cost-cutting merger.
Makes sense. But, okay, this is a big acquisition. How does that square with what the CEO also said? They emphasize that the most important growth driver is still hiring top talent, like one person at a time.
Right, and that's a really key point about Evercore's approach.
Is this a shift, or are these two things working together?
It looks like they see it as absolutely complementary. They describe the Roby Warshaw deal as, an exceptional, almost unique opportunity, great cultural fit, strong business reasons. It wasn't presented as a change in their fundamental strategy.
So opportunistic M&A on top of the core organic plan?
Exactly. And they backed up the organic focus, too. They mentioned that 9 senior managing directors and 1 senior advisor have either started already or are committed to join just this year so far.
Okay, so they're still aggressively hiring individuals.
Absolutely. It shows that commitment is still very much alive. So you have this dual strategy. Keep hiring the best people one by one, but also be ready to pounce on a really strategic acquisition like Roby Warshaw if the stars align. It gives them flexibility.
That makes sense. A dual approach. Okay, so shifting gears a bit, what about the broader M&A market? Conditions are still, let's say, fluid. How did Evercore navigate that, and what are they seeing ahead?
Yeah, fluid is a good word. But despite that, they clearly delivered. They pointed out that industry-wide global M&A volumes were actually up 30% year-to-date through the second quarter.
30%? It's a pretty solid jump.
It is. And management sounded, cautiously optimistic. They said backlogs continue to build. Client conversations are strong. They're hoping for greater clarity and stability in the M&A markets in the second half.
But cautious, you said?
Yeah, they definitely tempered it. They warned against expecting a full-on roaring recovery. So it's like, things are getting better, momentum is positive, but let's not get carried away. It feels pragmatic.
Does that 30% jump feel like a real turning point based on your experience watching these cycles, or is that caution still the main takeaway?
I think it feels like a genuine turning point, but maybe one that's still, finding its legs. The caution makes sense. Nobody's calling for a return to the absolute peak frenzy of a couple years back.
Right.
This feels more like a sustainable rebound, maybe, driven by real strategy, not just, free money. And a huge strength they kept highlighting is their diversification.
Ah, right. Not just M&A advisory.
Exactly. About half, 50% of their total revenues came from non-M&A sources, both in Q2 and over the last 12 months. That provides a really important cushion.
Yeah, that makes them less vulnerable to the M&A cycle swings. What areas are driving that non-M&A strength? You mentioned private capital advisory.
Yes, PCA. That business had a record first half and a record Q2. Just phenomenal performance there.
What's behind that?
It was driven by really high volumes in some complex specialized areas, things like GP-led continuation funds. That's where a private equity firm kind of restructures a fund to hold assets longer. Also LP secondaries, where investors trade stakes in private funds, and securitizations too.
Okay, so niche but growing areas.
Very niche, but increasingly important in private markets. And Evercore is clearly a leader. They expect that strength to continue, even though they admit competition is heating up there.
And it wasn't just PCA, right? Other areas were strong too.
Yeah, they mentioned strategic defense work, shareholder advisory, liability management, restructuring, all showing strong activity. Even equity capital markets, ECM, IPOs and follow-ons are starting to show signs of life again.
And the equity trading side.
Their equity franchise had its best second quarter ever. Apparently fueled by market volatility, more trading volumes. And don't forget wealth management. They hit a record $14.5 billion in assets under management, AUM.
So it's really strength across the board, not just one or two areas carrying the load.
Pretty much. That diversification is a massive part of their story right now.
Yeah.
Makes them much more robust.
Okay, let's pivot to costs and capital, because strong revenue is great, but you need that operational discipline too. How did they look there?
They look pretty disciplined. The adjusted compensation ratio, which is a key metric in this industry, actually improved. It came down to 65.4%. That shows good cost control, especially while they're still investing in growth. They want to optimize that further over time.
What about non-comp costs? Were those creeping up?
They did increase, yes, but it was mostly driven by strategic stuff. investing in tech market data, new software for clients, and also occupancy costs because they're expanding offices, New York, Chicago, Paris, Dubai, London, to support that global growth.
Oh, so growth investments, not just bloat.
Seems that way. And importantly, if you look at non-comp costs per employee, they were only up about 2.4% year over year. That suggests they're scaling pretty efficiently.
That's a good sign. And the balance sheet, still strong.
Very strong. Over $1.7 billion in cash and investment securities. Plenty of firepower.
And they've been returning capital too, haven't they?
Hugely. They returned $532 million to shareholders just in the first half of the year. That's through buybacks and dividends. And apparently that's a record amount for any 2 consecutive quarters in their history.
Wow. Strong commitment to shareholders there.
Definitely. They also did a $250 million private debt placement in July, mostly to manage upcoming debt maturities and for general use. And interestingly, they hinted they're strongly considering buying back the shares they issue for the Roby Warshaw deal over time.
Ah, so effectively making it a cash deal for shareholders eventually.
Potentially, yeah. Which again speaks to that financial discipline and thinking about shareholder value.
Okay, so pulling this all together. What's the big picture for you listening to this call? It feels like Evercore's in a pretty interesting spot.
I think unique position is a good way to put it. They seem really well placed to benefit from this sort of nascent M&A recovery that's happening.
Right.
But they're not just waiting for the market. They're actively trying to engineer their own growth, too, with moves like Roby Warshaw and that constant focus on hiring top people.
It does signal a potentially good environment for these kinds of focused boutique advisory firms, doesn't it? Especially with IPOs and ECM maybe starting to open up again.
Absolutely. And it's worth pointing out, Evercore stock has actually outperformed the broader S&P Capital Markets ETF, that's KCE, quite notably across different time frames.
So they're not just rising with the tide, they're actually beating the sector benchmark.
Yeah, suggests strong relative performance. They seem to be executing better than many peers.
Okay, let's circle back to that market reaction we mentioned at the start. Stock pops 7%, then closes up only 2.5%. You said maybe profit taking?
Could be some of that, yeah. People locking in quick gains.
But here's the interesting twist. Reports from options desks apparently showed dominant call volume. Lots more people betting on the price going up than down.
Ah, okay.
Okay.
Now that is fascinating.
What does that divergence tell you? Stock price action is muted, but options players are bullish.
It suggests a potential disconnect, right? The short-term stock traders might have hit the sell button, but the options market action, which often reflects, more institutional or smarter money flows, that heavy call volume implies there's a deeper conviction in further upside. Maybe the market hasn't fully priced in the fundamental strength or the impact of Roby Warshaw yet.
Okay, perfect setup for our next segment. And let's be absolutely crystal clear. This part is purely illustrative. It is not financial advice. Definitely not.
Absolutely not. We're just brainstorming here, like analysts pitching ideas, maybe slightly outrageous ones, to an investment committee for entertainment and illustration only.
Got it. So, considering everything we've discussed, the big Q2 beat, the smart Roby Warshaw acquisition, the strength in those non-M&A businesses, the cautiously optimistic outlook, there does seem to be that disconnect you mentioned.
Yeah, the stock popped, then fizzled a bit, maybe some lingering skepticism, or maybe the market just hasn't fully digested the news and the catalysts.
So here's the pitch, playing on that discrepancy.
Okay, let's hear it.
What about capitalizing on that difference between the solid fundamentals and that somewhat lukewarm immediate stock reaction, especially given what the options market seems to be signaling?
Okay, I see where you're going. You're thinking leverage the perceived undervaluation.
Maybe something like a synthetic long position, perhaps focusing on out-of-the-money call options, maybe expiring just before the Q4 earnings to capture potential positive surprises from guidance or the acquisition closing.
Right, so the idea is that you use options for leverage, betting that the market hasn't caught up yet. The heavy call volume suggests others might be thinking along similar lines, seeing upside that isn't reflected in the current share price.
Exactly. It's like betting on a coiled spring.
Yeah, the thesis would be, as Roby Warshaw gets integrated, as those M&A backlogs hopefully convert into announced deals, and maybe the overall M&A market gets a bit firmer, Evercore stock could potentially see a significant move upwards, maybe heading into that Q4 guidance update. It's definitely audacious because options mean higher risk, more leverage.
Highly leveraged, yes.
But you could argue it's fundamentally plausible based on the business momentum and the strategic moves they're making. Again, purely illustrative.
Purely illustrative. Okay, so let's wrap this up. To summarize, Evercore's Q2 call really showed impressive results, beating expectations, plus that bold Roby Warshaw acquisition for global expansion, and just the strength of having diverse revenue streams.
Yeah, the firm seems to be playing the game really well. They're balancing that aggressive hiring of individual stars with making big strategic M&A moves when it makes sense.
It feels like they're positioning themselves not just to ride the capital markets cycle, but maybe even to outperform it to grow faster than the market.
That seems to be the goal, yes. Balancing organic and inorganic growth effectively.
So here's something for you to think about. How might this dual approach buying firms like Roby Warshaw while still saying individual hires are key? How might that change the competitive landscape for advisory firms? What does it mean for the industry if M&A does find firmer ground?
Good questions to ponder. Lots of moving parts.
Definitely something to keep an eye on. Thanks for tuning in to The Deep Dive. We'll catch you next time.